there are two major questions. How does the tax rate affect the choice between labor and leisure? Any tax is going to affect that if it has a marginal rate above 0. But there's another choice. Once you've earned your income, do you save it or do you use it for consumption? That's the saving consumption choice. Or another way to put it is, how much capital do I want to accumulate under the current tax law and the current regulatory regime, and given what I think my consumers are willing to pay for the product? How much capital do I want to form, which causes me to either save more or save less to get there? So there's the saving consumption choice. Now, the current tax system interferes a lot more with the saving consumption choice than it interferes with the labor leisure choice, which is a little bit unfortunate because saving is highly flexible and capital can move across borders. Labor is pretty much stuck here and has to pretty much eat the tax you put on it. But here we go. If I earn money and pay my tax, and I use it for consumption, the federal government doesn't bother me very much after that. We put taxes on alcohol, tobacco, I think tires, bows and arrows, and ammunition. And I don't think there's much else going on. Okay? So if you're not buying one of those things, we're not bothering you again. So there's one tax on income that you earn and use for consumption. If I save the income and buy a bond, what I'm buying is a stream of future payments. There's a tax on that stream of future payments. So I bought the bond with after-tax money, and you're taxing me again on the thing I've bought with it. If I buy peanut butter and jelly and a loaf of bread, you're not going to tax me when I eat the sandwich. You've already had your crack at me. But if I buy a stream of interest, you're going to hit me again. Fortunately, on the other end, most of that interest is deductible. But in any event, it's not a good idea. This also falls on dividends, capital gains, and non-corporate business profits. If I have invested in a corporate stock, then there's the corporate tax in addition to the tax on the dividends and the capital gains that I get when I reinvest or when they hold the money back and retain it and don't pay it out as a dividend, which drives up the stock price. That's a third layer of tax. And if I then have estate and gift tax, that's another layer of tax on something that's already been taxed 2 or 3 times. So I've got potentially 4 layers of tax on saving and 1 layer of tax on consumption. And someone came up to me once who was a tax lawyer and said, I can show you family trusts that give you a 5th layer of tax. I said, I've run out of space on the chart. We actually try to fix some of that problem, and this is the IRA or the pension, whether it's Roth style or regular style. If there's no income tax, I earn $100, I spend $100. Or in the next line down, I can save the $100 and earn 4% forever, and that's the end of that. I get the $4 in interest. Now, in the next purple block, I'm going to assume an income tax of 20%. In order to consume 100, I have to earn 125. I pay 25 in tax, and I'm spending 100. The cost of getting the $100 to consume has gone up 25%. If I want $4 in interest, however, since that's going to be taxed, I have to earn $5. That's the dark purple. To earn $5, I have to have a $125 bond. To get a $125 bond, I have to earn $156.25. The cost of getting the income stream has gone up 56%, or 1.25 squared. Well, we fix it in 2 ways. With an IRA, where you deduct your saving and don't pay tax on it yet, I only have to earn the $125 to buy the bond. And then if I take the $4 out, the $5 in interest out, I will pay tax on that and get my $4 interest stream back. So deferring the saving and taxing it when you take it out eliminates that extra layer of tax on saving. With the Roth IRA, it's different. You pay your $25 tax up front, but then the $4 interest stream isn't taxed. The 2 methods are equivalent if you're in the same tax bracket as before you retire and after you retire. Why is this important? If you save $1,000 over your working life between, let's say, age 20 and age 70, in a pension, you're going to end up with $400,000 after tax when you retire. And if you put it in an ordinary saving where we tax it again and again and again and again as it's building up, you're going to only end up with, is that $240,000 in saving. We've taken away 1/3 of your growth. The ordinary tax treatment makes a big difference, and makes it harder to save and less attractive to save, and makes you more reliant on Social Security when you get there. Then there's the double taxation of the corporation. You've all seen this. These were the old rates in columns A and B, and the newer rates more recently. In 2003, If you earned $1 at the corporate level, paid 35 cents in tax, you had 65 cents left in the green. At a 15% tax rate, whether it was paid as a dividend or reinvested and sold off later as a capital gain, you had a little under 10 cents in tax. The shareholder got to keep almost 45 cents after taxes. I'm sorry, the tax was almost 45 cents. The tax rate was almost 45% combined, and the individual got to keep a little over 55 cents in after-tax money, having earned the $1 through the corporate sector. With the new act, the 2013 rates now, we have the top rate of 20% on the capital gain instead of 15, plus the surtax for the health insurance. And now the return after taxes has dropped to 49.5 cents from 55. It's a good, healthy 10% drop in the rate of return on the saving. And if saving is at all elastic, you're going to get some drop in saving and investment. We've knocked out a good deal of the improvement that was done in the mid-2000s when we cut the tax rate on capital gains and dividends to 15. We've taken a good chunk of that back, particularly in the capital gain area. I've gone over some things that hit the tax base, that hit the tax rates. But here's something that hits the tax base quite directly. In writing off those plant and equipment investments, I lose time value of money. The blue line shows a $1 write-off, whether it's a 3, 5, 7, 10, or 39-year asset. If I expense the $1 I spend today, I get an immediate deduction for it, and I save my tax rate times $1. If, however, I have to delay the write-off for 3, 5, 7, or 39 years, the present value of that write-off falls, and the present value of the tax saved goes down, and the cost of the machine or the building goes up. And the higher the rate of inflation, the worse the problem. A building stretched out over 39 years at 5% inflation has a write-off equal to only 30 cents on the dollar. And instead of saving 35 cents in tax, it's only saving 10.5 cents. It has to earn that much more on the building in order for that building to break even. So if someone's looking to build a building or looking to buy a machine, and they're looking out at inflation and they're looking at the tax rate structure and the depreciation, they're going to factor that into their decision as to whether they're going to get enough back in after-tax money to cover the cost of the machine. Will they do it or won't they do it? The estate tax, of course, starting at 40%. You're all familiar with the generation skipping tax. If you leave money to your grandchildren instead of your children, the IRS does not want your kids to feel left out. So they charge you the tax as if you had given it to the children and that they had then turned around and given it to the grandchildren. So they put on the 40% tax on the initial amount and then another 40% tax on the remaining 60 cents, and they get a combined rate of whatever that comes to. If you are working or saving in your old age and you're not planning on spending it and you're planning on adding it to your estate, you first have to pay the federal income tax and the state income tax, which can boost the combined rate to 81 cents. And if you're working and paying the payroll tax too, the marginal tax rate can approach 84%. And that did assume a 6% state income tax.